Welcome and thanks for joining us. Really excited to have with us today an investor in frontier markets with boots on the ground, Chris Tell, who is been investing in emerging and frontier markets for the last 15 years. His own capital, as well as running a syndicate for high net worth families looking for opportunities to invest in markets that others are ignoring. Chris, welcome.
Thank you very much. Pleasure to be here.
Well, I'm really excited to learn from you. You have a vast experience in many of the countries that others don't even know where they are on the map. You've been running a wonderful blog and sharing some of your exploits as you meet with companies and look for investment opportunities. It's at CapitalistExploits.at. And perhaps a good place to start the discussion would be just to tell our audience a little bit about yourself and what got you interested to spend your time looking for opportunities in frontier markets.
Sure, Oliver. So my background is as an investment banker, but it was a world that I left many, many years ago, and managed to make sufficient amount of money to step out of working for the man, as so to speak. I met my current business partner, Mark, about 4 years ago through a mutual friend in Panama, and we found that we were typically following a similar line of investments with respect to placing our capital into a lot of private placements, and in markets which were fast growing, had massive tailwinds behind them, and typically were off the radar and undervalued and overlooked. So long story short, we started up Capitalist Exploits, really just to see if there were other crazy people out in the world that were following the same sort of things as we were, because we found that the information was very difficult to come by in a lot of these markets, and that information which was out there was typically wrong or misleading. And so we thought we'd sort of reach out, and it's been quite a rewarding experience. So my my idea for getting into frontier markets is really back some years ago. I was living in London, working as an investment banker, sort of 15, 20 years ago, and it seemed clear to me that the growth in the world was going to be coming from Asia. So I shifted myself out to this part of the world to be closer to where I felt that the opportunities were going to be. And I've watched many of these countries transition from really poverty-stricken little dirt hovels to what are now, one could easily consider some of the best cities in the world. I take Kuala Lumpur, for example, and the first time I went there, it reminded me of many African cities where I'd grown up. I spent my youth growing up in Africa, and it reminded me a lot of that. And if you go there today, you'll find that it's this gleaming metropolis. It's an amazing city. It resembles absolutely nothing of its former self, and that's the same is true across many of these Asian countries. And I think increasingly we're going to have a lot of growth in certain African countries. But the frontier markets in general is a very interesting space for us. It's makes up about 4.4% of global GDP, and at the same time, the market cap is about 0.4%. So you can see there's a large divergence with respect to ownership of listed equities within frontier markets when comparing it to the amount of output from those same markets. So the sector, or I don't know if I want to call it a sector, but frontier markets themselves are certainly uh, in the position to grow faster than those countries in developed markets, certainly, which are massively debt laden, have poor demographics, fiscal problems. I won't get into it. Everybody watches the news, so they know what's going on.
Uh,
Um,
and
yeah.
before you continue, perhaps it would be in order to actually define what do you then mean by frontier markets, the figures you've given us. How do you then define that opportunity set? And more perhaps interestingly, where do you draw the line between emerging and frontier markets?
Sure, that's a very good question, Oliver. Frontier markets itself was only drawn up in, I think it was 1992. The concept came about by a woman by the name of Farida Kambata, and she coined the term frontier markets. There's been many people who've debated about what exactly a frontier market is and what it isn't, but I think essentially what you're looking at is a market which has very low um, equity participation. In it is a very undeveloped market. So some of these markets don't have equity markets at all. Others have very small equity markets. So I would define a country, for example, like Cambodia, as a frontier market. It has an equity market, but it has one listed equity. Laos is another one. Mongolia, I would consider frontier markets, as opposed to an emerging market. I guess one could look at the BRICS, which would be considered emerging markets. They have far greater developed equity markets. They have far greater levels, typically, of transparency. Corporate governance is I don't. It's a little bit difficult to be generic about it, but if we're going to try and be generic, then we'd say corporate governance is better in emerging markets than it would be in frontier markets, though that is not always the case. There is certainly a lot more liquidity in emerging markets. Frontier markets are highly illiquid, which in itself doesn't trouble me. It actually allows me to find mispriced assets, because with illiquidity comes the mispricing of assets. Credit markets are very underdeveloped, and sometimes the domestic credit markets are almost non-existent in most frontier markets, which incidentally is almost a reason to own them in the world that we currently are living in, which is highly indebted, certainly in the developed world. Um, Global debt to GDP is now running nearly 350%, which is really an astronomical level. It's levels that we've not seen at any point in history at a time of peace, which is quite troublesome. And if we look at the frontier markets, typically many of them are far more fiscally sound. They don't have the debt levels, partly because nobody wanted to lend them money. And as such, I think that the risks, because there's two sides to any investment. One is reward and the other is risk. And so the first step for myself and for any investment that I make is mitigating risk. And so, yeah, that would be, I guess, how to define frontier markets. There are very large discrepancies across. I mean, you could take North Korea. That would certainly be a frontier market. At the same time, a country like the Czech Republic is considered, or would be considered, a frontier market. But the difference between North Korea and the Czech Republic is vast. So it's difficult to be generic about it.
But if we just focus on Asia, then, which seems to be your hunting ground, would perhaps one key variable also be the GDP per capita of the countries? If I look at some of these countries, and what perhaps surprised me is to find out that a country like Malaysia is pushing toward, let's call it, 20,000 US dollars of GDP per capita, whereas you have Indonesia still at around 5,000, or Vietnam at even less than 5,000, or Pakistan also less than 5,000. Is that perhaps a good variable as well?
Yes, absolutely, absolutely. So Malaysia, I would consider an emerging market. And so if we stick in Asia, then if we look at Cambodia, it's running about $2,100 income per capita. So vast, vast difference. And that is where that is that is exactly where we want to be positioned because if we go back ten years ago, Cambodian income was around about $900. So today it's about just over $2,000. So for most of your listeners, I guess they'll be sitting there thinking, well, what big deal is $1,000 over a course of 12 months? That's absolutely nothing. At the same time, it's the percentage increase that is important to consider. And if you were to ask anybody in the developed world, has your income doubled in the last, your real income doubled in the last 10 years? And you could almost guarantee yourself that that's not the case.
It's probably gone down.
It's probably gone down in real terms because of inflationary quantitative easing and so on and so forth. So that's absolutely true. And what you find is that disposable income expands rapidly. So you and I could not live on $2,000 a year. However, if you've been living on $900 a year and you now are in the space where you're earning $2,000 a year, theoretically, you're in the position where you have over $1,000 of disposable income now, which was previously not there. And when you look at a lot of these countries, you're looking at population sizes of 90, 100 million people. So the the growth rates can be stupendous. If we take Myanmar, where we were last year for some time, um, for example, mobile penetration rates, those have been expanding like 100-fold because people, they can afford a cell phone, whereas they previously couldn't. And you've got arguably, no one's done the statistics yet, but the indications are there's about 70 million people in Myanmar. So we have this massive untapped market, and those companies that are positioned well see expanding margins of something crazy. I mean, I'll give you a quick example. There's a company which we were looking at providing seed capital to in Myanmar. They set up a travel portal because there isn't one in the country. And it's simply a website you go onto and you book hotels, airline tickets, things like that. Now, they set this up in, I think it was October last year, October of 2012. The first month, they did $5,000 in revenue. This in the first month that they were actually up and running, which was November. December, they did 15,000. January, they did 150,000. And I haven't yet got the figures what they did in February, but you can see the percentage increase is completely massive, and that's not it's not unique. So these are the sorts of markets that we tend to focus on because we can realistically invest in deals where we can get 5, 10, 20 times our capital return. And I don't know any other markets where I can do that, short of using derivatives and taking on enormous leverage and risk.
And I want to jump in here and actually just take a step back and ask you one thing about the growth. And it seems to be that most people that I talk to, clearly they get the growth of the emerging markets, and then often the argument is made that you push further into the so-called frontier markets and the growth is even better. So it's often that argument about growth. But as investors, we all know that growth certainly doesn't correlate with investment return. GDP growth doesn't correlate with investment return. How
The
do you
reason that
approach then the opportunities? Where do you find then attractive opportunities to actually find good risk reward situations in those markets?
I'll first come back to the point that you make, which is entirely correct and a very astute observation. So GDP growth does not necessarily correlate with equity returns. And I think that in large part, the reason that we have that, certainly in frontier markets, is because the sheer lack of available listed equities. So you'll have this stupendous growth in the markets, and you will have companies themselves who are doing very, very well. But then those companies that are accessing the capital markets, uh, there's two things that happen. One, if you have um, interest in that particular country. So a country like Myanmar now is, I think, a prime example. There's a lot of interest in Myanmar. There's a lot of hot money pouring into the country, and listed equities are almost non-existent. So those that do exist tend to get bid up, um, and the valuations just don't make a whole lot of sense. People pour their capital into the country because they think that there's a lot of money to be made, and they are correct. However, they are completely incorrect in the way they're participating in that country. So this is essentially the reason that we tend to focus on private equity rather than publicly listed companies, which is not to say there are not good publicly listed companies in some of these markets. It's simply to say that it is far more difficult to get good valuations on the publicly listed companies because it's a supply and demand issue, and you have too much demand for a small supply of listed equities, and you find that the returns for those equities are not commensurate with the risk.
And let's perhaps to illustrate that, and also for myself, I'm based here in London, and much of our audience is in developed markets, the US, Western Europe, and perhaps it would be good if you could just give us a flavor for actually what you're dealing with, and help us appreciate the challenges that you face in these markets as an investor. Tell us even a bit about the practicalities of investing, and what options are there to invest in a market like Myanmar today. Perhaps if you want to pick one of the countries that you're excited about and give us a bit of a flavor for what it's like to be an investor in that market.
Well, I think right now, I mean, we could talk about Myanmar, but I think what's interesting right now is Mongolia. So Mongolia we've been invested in for quite some time. And right now, we believe there's a unique opportunity, and this goes for listed companies, which is why I think it's best we speak about Mongolia because Myanmar doesn't have listed companies for the most part. There are a few in Singapore. I think they're overvalued. There is an enormous amount of hot money pouring into Myanmar right now, and I would be very surprised if over the next 10 years we do not see a lot of investors losing their shirts there because it happens every time. So right now in Mongolia, there are a lot of political upheaval with respect to the Oyu Tolgoi mine, which is easily the largest capex project in the country, that's largest the country's ever seen. And that our sources on the ground tell us is essentially because we have uh, in March political elections. And so the rhetoric that comes out is really vote buying. The politicians that we've spoken to, the politicians that our sources on the ground have spoken to, are unanimous in that they would never let the Oyu Tolgoi mine not go ahead. And so we believe that right now there's a unique opportunity to acquire undervalued assets in the country because the market perception is that there are a lot of problems, and the reality of the situation is that those problems will be solved. Um, and so, if we look at it's where we've been placing capital, we over the last 2 months have participated in two deals in Mongolia. One of which I'm happy to talk about because the deals and the pricing level that we got in at are now passed, and our syndicate already invested. So there's no sort of proprietary information that I'll be divulging. One of the companies, we bought a block in a company called Euro4Asia. They're a fire services company. They provide fire protection services to companies in Mongolia, and they are easily the market leader. They have, of the 100 top companies in the country, they have 99 of them on their books. So they're growing their revenues at about 18% compound annual growth rate. They're expected to reach about 25% for 2013. And so their growth trajectory is massive. The company was founded back in 2001. And if I give you a little, some revenues to indicate what sort of growth rates are achievable, much like I spoke about the company that we were in discussions with in Myanmar, there's a similar sort of pattern here. So the company, I think in their first year of turnover, they did over $5,000, and that's grown to about $510,000 per year in 2012. Then they have just completed a reverse merger on the Mongolian Stock Exchange. If we look at the valuations of similar companies on the exchange, we could easily come to a PE of about 20 times earnings, and this company currently trades at about 7 times earnings. Globally, fire service companies average 47 times earnings because they're a service-oriented company. They have very, very low capex, and so you can see the sort of upside potential in that particular company. That is a listed company. Anybody can go and buy it. I'm not soliciting it. I'm an investor and a shareholder. But so that's one deal that we participated in. There's another deal which again,
and just sorry, before you talk about the other one, perhaps I can just ask you to share with us, if with the audience, if whoever is interested to look it up, just the name of the company and perhaps the Bloomberg ticker. Sometimes
sure.
it's difficult
so
even to find out what the company is.
Absolutely. So the company's name is Euro4Asia. It trades on the Mongolian Stock Exchange and under the ticker SOI. So if you can go onto the Mongolian Stock Exchange website, look under the listed companies, type in SOI, and you'll see Euro4Asia. So yeah, the liquidity on any Mongolian Stock Exchange shares is limited. You will need to be patient and bide your time to build your position, and the same thing on exit. But we believe that when the dust settles with the political situation in Mongolia, we're going to slowly start seeing capital come back into the country. And let's not forget that in the third quarter of this year, Oyu Tolgoi is going to be producing their first revenue in exporting. This is going to bring enormous amounts of capital into the country, and we believe that the growth story of Mongolia hasn't gone away. We've got a population that is minuscule with enormous amounts of capital coming in, and what happens is you get bubbles. It's as simple as that. We simply want to be ahead of the bubbles and exit when valuations get silly. So that's the other company that we participated in a private placement with is also a publicly listed company. It's called Prophecy Coal. They trade on the Toronto Exchange under the ticker PCY. This is a company which we've been watching for about 9 months, and they were very poorly managed. There was enormous corruption. They had a burn rate of about $900,000 a month when we first looked at them 9 months ago. And the reason that we started looking at them was because of new management. We know the management very well, and we have a high level of confidence with management. What they did was with the new management they brought in, they basically started turning the company around. eliminating waste, getting rid of corruption. And that burn rate, they whittled down. The February figures posted the first profit the company's had, and it will continue making a profit going forward. So the profit was only, I think, about $24,000, but it's a $1 million turnaround in 9 months. The valuation of the company itself, as it's listed now, is about 14 cents a share. Values the company at about $30 million. And if we look at the assets, this is completely insane. Prophecy itself owns a 37% stake in another listed equity called Prophecy Platinum, which is publicly traded. If we simply take the valuation of that company and multiply it by the 37%, we get to roughly about $26 million. Okay, so let's not forget that Prophecy itself is currently being valued for about $30 million. Then Ernst & Young have recently completed an audit on their assets, valuing simply the mining equipment at around $30 million. So we're essentially buying the mining equipment. We're getting the Prophecy Platinum 37% stake, which is $26 million. We're getting that for free. And the real kicker is that they have just recently, Prophecy Coal has just recently secured the power plant land use rights to build a power plant at their Changdana property. At the same time, they've simultaneously joint ventured with a Chinese power company who will fund 100% of the construction. Prophecy will retain 80% of the coal mine supplying the power station, as well as get a 25% stake in the power plant. Anyone can go and actually have a look at the details on their website. But if you go and you have a look at the EBITDA for the mine alone, this will likely be in the region of $40 million a year. So if we take a conservative valuation of 9 times EBITDA, considering the fact that they've got the 25% ownership of the plant as well as many of the other Prophecy assets, we've come to a $1 billion market cap, which I don't think is actually unrealistic for this company. That amounts to about a $3 per share on a fully diluted basis. From today's investment at 14 cents, that's about a 20 times the return on the shares alone. So in full disclosure, we participated in a private placement with the company, including warrants and things like that. And that private placement had massive insider buying. All of the shares were taken up by management, and the only reason that we actually got a placement in it was due to our relationships with management, where we essentially begged them for a stake. But the company, as it is now, I think is ridiculously undervalued, and it's simply not covered. I mean, I don't know many analysts who are even covering the company. But if they run the numbers, they'll see that you're buying it for less than its net present value. And there's the agreement with the power company to go and build this power plant. So those are 2 deals which we've just recently done, and I'm happy to talk about.
Yeah, thanks so much for sharing those. I'm really curious on Prophecy to understand a bit more around the business itself. Perhaps the first question is actually on the private placement. So at which price was that done?
The placement was actually at market, but it has an 18-cent warrant attached.
Mm-hmm.
So it was at 14 cents, which is literally anybody can go out and buy the company now. It's trading at about 14 cents, 14 cents a share. So,
yeah. And what's the ownership now post this raising? So can you give us a sense of the ownership of the company?
They have a strategic investor, which is the Chinese power company, who came in for I think it was 40 million shares. There was a 60 million allocation, and they came in for 40. It has I have to have a look at the financials, but there's about 30% of the company is owned by, by management, and the balance is institutions, and then the joint venture partners come in for a large stake of it. So it's, yeah.
So it's really, I guess, it's the float publicly is quite small. How much do you know? Does it roughly trade in terms of just the trading volume?
Um, the volume is relatively low, but it's one of the more liquidly traded Mongolian companies. So it trades about 50,000 shares a day, which is not enormous, but it's sufficient. There's low liquidity in almost any of these assets. I mean, I think if we look across the Mongolians landscape, Turquoise Hill is probably the most liquidly traded company. Excuse me, which is Rio's stake in the Oyo Tolgoi mine. But Prophecy is, yeah, there's sufficient volume there to build a position and to exit as well. If we look at some of the companies on the Mongolian stock exchange itself, then we're looking at very, very low liquidity levels, which itself is, like I said, that's not a problem for me per se. It's at times it simply allows us to buy undervalued assets, because when liquidity comes to a stock, typically that's when you want to be exiting. And you want to be buying when there's low levels of liquidity, and you can build big positions in undervalued assets. So, but yeah. So coming back to Prophecy, there's about 50,000 shares a day that trade. The average volume, I think, over the life of the stock is many multiples of that. So this gives you an indication of what the market's looking at right now. Mongolian assets are not being, the market's not interested in them, and volumes are way down, asset prices are way down. I mean, I think when I look at it, I think it was 2 years ago, Prophecy was probably trading 200,000 shares a day, something like that,
Mm-hmm.
to give you an indication of the levels of volume and how they've changed. So, I mean, if you're a listed equity investor and you're purely looking at listed equities, that's just another source of information that you could look at, is having a look at companies and the volumes and seeing whether volumes are collapsing, and then looking into the reasons why that might be the case. And if those reasons are valid, that's all fine and well and good. And if they're not, then you might have the potential to be buying assets that nobody else wants to buy, and the market perception does not correlate with the reality on the ground, and which is exactly the situation we believe is present in Mongolia today. The valuations and the perception, the market perception, does not meet the actual reality, and that presents the opportunity.
Well, spoken like a true contrarian, and I certainly share, I can relate to what you're saying. Clearly, that's the time to buy when nobody else is, provided that you have a sound thesis. And just to come back to the business itself, I'm curious if you could tell us a little bit about why it was listed in, why the listing in Canada, and also if we look at, you talked about the market value and the assets and the value of those as you see them. I'm curious, for these types of businesses, there often is a lot of debt on the balance sheet as well. Can you tell us a bit about, does this company have any debt, and what are they doing with the money from the private placement?
Sure. So, um, uh, sorry, what was the first part of the question?
I'm just curious a bit about the history, assets in Mongolia, listing in Canada.
Oh, right. Yeah.
Where does that come from?
Well, Canada is the resource capital of the world. if anybody wants to go and raise money for resource-based businesses, capital is the easiest place to do that is in Canada. That's been the case for many years now. So you'll find Ghanaian assets or Tanzanian assets or companies operating all over the world where they go to raise capital, they do so in Canada. And so they'll have a corporate office in Toronto or Vancouver. That's where all of the resource brokers are housed. It's really the hub for resource-based businesses. The second one that we sometimes find is on the ASX, on the Australian Stock Exchange. So when you're looking at large companies with big capex projects, whether they be in Mongolia, in Laos, in Papua New Guinea, they're not going to be raising capital on the domestic markets because the domestic markets are far too small. And so they go to markets like Canada and Australia. So if we look across the scope in Mongolia, most of the large companies that are operating there haven't got a listing in Mongolia. They're either listed in, there's quite a few listed in Australia, there's a few listed in Canada. So that's the reasoning behind listing in countries like that. In fact, there's another company, this is a little bit off tangent, but there's another company called Mongolia Growth Group, which is listed in Canada as well. It's not a resource company, it's actually a real estate play. And it goes under the ticker YAK, Y-A-K. In full disclosure, that's a company that we seeded about 2.5 years ago at 60 cents. I think it's still undervalued at the present time. It's trading around about $4 a share. But they took that listing and they listed in Canada again because of liquidity and because they could raise the capital in the Canadian markets more easily than they could in domestic markets in Mongolia. I mean, most investors don't want to be going and setting up a brokerage account in Mongolia. It's much easier if you can trade these stocks through your E-Trade account or your Charles Schwab account or something of that nature. So the regulatory issues are a little bit more cumbersome, a little bit more costly. Running a public company is not a cheap affair. You're still looking at probably $100,000 a year in public company costs and auditing fees and so on and so forth. But if you're going to be doing anything of any size, then you need to have sufficient capital to do so. And to do that, you need to be going to the offshore markets. And that's really the reasoning behind listings in Canada and places like Australia. There's a few in Hong Kong as well, but for the resource company, most of the stuff is Canada and Australia.
And actually, related to that, I see that the management team is Western. John Lee, the chairman. So can you talk a little bit about
management?
Yes, I guess the management, and we're dealing with an asset in Mongolia, essentially owned and run by foreigners, and the listing is in Canada. So, in your
Sure.
experience, does that sometimes pose red flags, or how do you get
Yeah,
comfortable that
very good question, Oliver. Very good question. So you have, I think a red flag is always if you have a company where management is not in the country, and it's essentially, I've seen so many of these. In fact, one just the other day came through, guys who approached us trying to raise capital for a company that got in Borneo, and they're essentially just paper tigers. The management don't live in the country that they're operating their particular business. They don't know. They really don't know what they're doing. And so there's two sides to this. If you've got foreigners running a company, can be very good because you have foreign expertise that's very much needed in some of these markets. At the same time, if the foreigners that are operating the company don't actually know how to deal with locals, then you're looking at a real problem. With respect to prophecy, the general manager is a gentleman by the name of Oscar Mendoza. Oscar is a good friend of ours, and he's been living in the country for 2 years. He knows how it operates. He's been very successful in other businesses as well. And we one of our strategies, and easily the biggest key, I think, to our success is we don't so much buy companies as we buy management. I've seen plenty relatively mediocre companies that have done well with good management, and at the same time, I've never ever seen a company get better with poor management. Even if it's in the right space, if it has great financials, if you've got poor management that comes in, they manage to destroy shareholder value. It's as simple as that. So for the most part, we tend to buy management. We spend an enormous amount of time making sure that we understand management. And prophecy is essentially that. The reason we started looking intently at it was when they brought in Oscar Mendoza to start managing on the ground operations. We know how he operates. He doesn't take he doesn't take no for an answer, and he's very astute. So he's on the ground, running and managing the fair. John Lee's there for the most part. He spends a lot of time in China as well. But it's a very valid point that you make, having foreigners running a company. Like I said, they can bring a lot of technical expertise to countries where the skill set doesn't exist, and Mongolia certainly fits that bill. They're short of skills, so for entrepreneurs, it's a fantastic place to go if you wanna make your fortune. There are so many opportunities that we've seen in the country, but we can't participate in because we don't want to be going and running businesses. We're not and don't pretend to be business owners. We're investors first and foremost. But the opportunities exist, and we're always looking for smart, intelligent businessmen who we can back in particular ventures. And coming back to Mongolia Growth Group, which we spoke about before, we were backing a particular person. So a hedge fund manager by the name of Harris Kupperman looked at the country. We discussed that he believed that the opportunities were too great to not get involved, but couldn't get comfortable with investing in existing companies. So he decided to move himself from sunny Florida to freezing cold Ulaanbaatar and set up a company, and he did that. And he's running the company over there. They've been very, very successful. And to answer your question, we spend a lot of time looking at management and making sure that the management have a vested interest in the business. They're on the ground, and they're not just running a paper scheme.
Mm-hmm. Just to get back on prophecy then, in terms of also management's capital allocation, if you could give us a sense as to the debt that I mentioned before. Is there any debt here, and where they're putting that capital to work? I think also, if I remember, you mentioned on a fully diluted basis, you would expect the intrinsic value to be around 3, was it, over time? And I guess the key question there is to get to where they are going to be in 3 years' time. How much capital do they need to raise still? If you could just give us a flavor for.
Well, the joint venture that they've got with the Chinese company is one whereby the Chinese company are bringing all of the capital to the table.
So prophecy today doesn't have. Does it have debt?
So they have a small amount of debt. I don't have the figures in front of me right now, um, but it's completely manageable. The big capex is the power plant. Um, in fact, well, coming back to the debt situation, so Prophecy will be the only company this year that will actually produce revenues. I think there's one other one. I'm trying to think now of the name. There's one other company, Centera. Centera are going to be producing positive cash flow this year. But there's no other mining company in Mongolia right now that's actually positive cash flow. Even Turquoise Hill won't hit positive cash flow until the third or fourth quarter. Not Hunu Coal, not Haranga, not Aspire. None of these companies are going to be cash flow positive. So that's for me that eliminates an enormous amount of risk. The debt is serviceable that they have; it's very low. The um, uh, the assets on the balance sheet are have all been audited by Ernst and Young, so we know what the value is there. I mean, essentially, this company, you could asset strip it and double your money right now. So for me, it's a relatively comfortable sort of situation to be placed in. But the real kicker comes with the power plant deal, and so that all of the capital required for that, which is going to be expensive, is being brought in by their Chinese partner, and um, and so there won't need to be any dilution to shareholders from that going forward. There's the deal is such that they will they will be giving up 20% of the coal mine in that deal, but then they're getting 25% of the power plant, and that's far more valuable, as well as the fact that the coal mine then has a steady stream of demand for its production. So all in all, I think the sun should be shining on Prophecy over the next certainly over the next 5 to 10 years.
So, is it fair to characterize it as quite an unusual, low capital intensity proposition in an otherwise very capital intensive
Well,
industry?
it's capital intensive. It's just a Prophecy don't have to come up with the money.
Exactly, that's what I mean, which is a nice way to structure it.
Exactly. That's right. That's right. And there's two things right now. So the equity markets in Mongolia and Mongolian assets are being undervalued. There's not a lot of interest in pouring capital into Mongolia, mostly because of the discussions around Turquoise Hill with the government. And the Mongolian government turned away Chalco from which is a Chinese company who wanted to invest in the South Gobi Sands deal, and so that put the kibosh on foreign capital coming into the country. A lot of big investors said, no, well, we're going to hold off and we're not interested. Thus, the falling in prices of equities. So at the same time that it's difficult to go and finance something like this, um, if Prophecy were to do it, they would have to dilute in a massive, massive way to raise the capital to go and build the plant themselves. Now, dilution in itself is not necessarily a problem if dilution is accretive to shareholders, but it would only be accretive over probably a 2-3 year time frame, which isn't too short, certainly for a coal mining company. But in this instance, it's not something that they have to worry about as such. So yes, there's dilution simply in terms of the fact that Prophecy are going to be giving up some of their coal mine, but it's certainly an accretive dilution, and um, it's not directly dilutive to shareholders right now. I mean, look, you're buying, if, like I said before, you're buying the assets of the company now. The fact that the coal mine, you're losing 20% on a coal mine is really neither here nor there because the market's not even valuing that coal mine right now. It's pretending that it doesn't exist.
I'm curious if, so you said that this is cash flow positive, and certainly, I guess there is not much liquidity, so perhaps it's too much to ask for, and that's, I guess, when the frontier markets are different from, let's say, a US market. But this question of, well, if they're generating cash flow, certainly what would seem a very prudent capital allocation decision is to buy back some shares. But is that very much, uh, well, there's just not enough of a free float there to do that?
Well, the placement that they did, for example, one could almost consider that to be a buying back of shares because management took everything. There wasn't, in theory, yes, it was a private placement which any accredited investor could participate in. In reality, nothing was available. Management went in and bought everything. So, if you're going to, I know a lot of investors who simply look at insider buying. This is a case of extreme insider buying.
Which of course is great, and gives you even more confidence as an outside investor. I'm curious. So if I look at the chart here, it looks like the share price is down from around 50 Canadian cents to just around 14. And in your view, that's all due to these unrelated macro uncertainties hitting Mongolia in terms
Well,
of.
no, it's two things, Oliver. One is that the company was mismanaged. It was, like I said, it was burning through $900,000 a month.
Mhm.
Um, it uh, uh, it was a terribly mismanaged company. I mean, they had, I think, of every 5 trucks that were carting coal out, they were lucky to get one that was full out of it because a lot of the stuff was being siphoned off. I mean, fuel was being siphoned, all sorts of crazy things like that, which in fact happens a lot in frontier markets when things are mismanaged. I've seen it happening in Africa and Indonesia and places like this. And what you need is very strong management um, who know how to operate in these countries. And that was what prophecy was lacking. So I think there's two aspects. One is that the market was um, correctly valuing the valuing prophecy if it was to continue along those lines because it would have gone bankrupt. Um, so, you know, they say markets look forward, and certainly investors were looking forward and saying, well, this is what's going to happen with prophecy going forward, is that, they're going to keep burning through nearly $1 million a month, and eventually the thing will go to zero. They're always going to have some sort of assets, and those can be liquidated. But if you're a bondholder, that might work. If you're a shareholder, it's probably not going to work. Um, and so that was one aspect. The other aspect on top of it is the overall perception of Mongolia at present, and that's a result of the political, um, shall we say, negotiations that are being had between the Mongolian government um, and Turquoise Hill around the Oyu Tolgoi project. So that's what everybody's been looking at when they're looking at Mongolia, and frankly, it's what everybody is concerned about. Because if that particular project was not to go ahead, it would be an enormous impact for the Mongolian economy. Um, it's so. Those are the two factors which have both been a massive headwind for any company in Mongolia, but certainly for Prophecy, because one was that it was mismanaged, and the other was that you had these external factors which were making it very difficult for to raising capital in for Mongolian equities.
And when did the new management then come in?
It would have been, don't quote me on this, I think it was about July last year, June, July.
Hmm.
Might have been June, something like that. Yeah.
Well, Chris, thank you so much for sharing this idea. Certainly, it's a very contrarian idea with a lot of company-specific catalysts and certainly cheap, as you've described it. So that certainly gives us something interesting to do some research on and study ourselves. Perhaps if we step back a little bit, and I think you mentioned earlier that some of these capital flows tend to result in silly euphoria with some countries and markets. And just for our audience, I think it would be helpful if you could perhaps share with us where you think in Asia you're seeing some of that euphoria, and perhaps mention any other interesting countries or markets where that are similar to Mongolia.
Sure. So if you look at, I mean, I mentioned Myanmar, for example. So Myanmar is certainly opening up. There's absolutely no question about that. Um, so for your average Westerners, I'll call them a Westerner, someone in a Western market,
Sure.
uh, sitting reading news headlines, thinking, "Wow, this is a fantastic opportunity. Myanmar's opening up." And let's not forget that Myanmar used to be, I think it was the ninth largest producer of oil in the world about 50 years ago. And today it's got nothing. I mean, most of it's jungle, and uh, it's poor. They produce almost nothing. They import almost everything. And so they're opening up, and we know that the country is endowed with enormous resources, natural gas, oil, tin. I mean, there's just so much tin, it's insane. Gold, coal, and these are just some of the things that they know exist, and 99% of the country is unexplored. So from the resource side, it has enormous potential. Geographically, it's very well positioned because it sits on the border of China and India. Now, the Chinese have been involved in the country for quite some time. They were never restricted to like the United States or any of these countries. You know, they can and do invest in any country they please. So they've been investing in the country for some time, and they're building pipelines and highways and things like that, whereby they will be able to get goods straight through to China without the need for them to sail around Singapore, which is an interesting sort of geopolitical move in itself. And Singapore is not particularly happy about that. So they're building a large port um, in Myanmar that's going to help facilitate that. So there's all of these massive projects which are going on. Now, these projects are being done by big multinationals. You can invest in those multinationals, and you land up by essentially getting a small percentage of the possible profits that are made out of that, simply because they're large companies, and these projects account for a very small percentage of um, their global share of businesses. But we don't really like participating in that space. Um, the other thing that what happens then is investors look and they say, okay, well, if I don't want to participate in the large oil and gas guys, Exxon or Caterpillar or anything like this, how do I get exposure? And so they go after the few companies that do exist on listed exchanges. There's a company called Yoma Holdings, which is traded in Singapore. Um, as far as I can tell, it's a relatively well managed company. We've met the CEO, Serge Pun, and he's certainly very well connected. The company is essentially a conglomerate company managing real estate and agriculture and banking and all sorts of things in the country. but the valuations are completely silly. So, and they're silly because there's nothing else you can buy.
So would Myanmar be a good example of if you look, if you're talking about a country, it's great prospects
Yeah,
potentially, but
it
as an
has
investor, there is not much to do.
it has all of the fundamentals that are required. The difficulty is in how do you place your capital. So what happens is you've got a lot of guys who come in there and they go, okay, I want to go and invest in this country and I'm going to start up some business. Now, to give you an example, at the US embassy, there are, and this was, I think it was um, August, September last year. I can't remember when we went and spent some time there. Of the 24 companies at the time that had entered into joint venture agreements in Mongolia, fully 22 of them were in dispute. So if you think about that for a minute, do you want to be investing in these companies? And the answer is no, because the majority of them are going to be losing money and going away. Um, the other thing that happens is people go after real estate. They think the easiest way to play a particular growth trend is to buy real estate. Sometimes that is absolutely true. Sometimes it is not. Myanmar is a perfect example of a lot of foreigners throwing money into assets which make no sense whatsoever. So real estate is one of them. There's if you and the reason for that is that the capital markets within Myanmar have been closed off. So if you were a citizen of the country, you could not get your capital out of the country. Also, there was essentially, for arguments, for all intents and purposes, there's no banking system. So people used cash and gold. That was how you held your money and real estate. When they opened the markets for individuals to own real estate, an enormous amount of domestic capital went into real estate because it had no other home. The banks really don't exist, so um, the money went into real estate. And there's a little town, for example, close to the Thai border called Myaik. I've been looking at this for about 10 years. Now, it makes a lot of sense that that particular area would do well. It is beautiful coastline. It's similar to that which you find in Phuket. It is very close to Thai infrastructure, so building a road to get in there is cheap relative to elsewhere in the country, which has almost non-existent roads. Um, and at the same time now, the prices have been bid up to the level where they are more expensive than real estate in Phuket. And it is still just jungle. So when you have, at some point, what's going to take place is that a lot of this domestic capital can exit the country. It will. And you're going to have a lot of the values come back to earth. So for foreigners coming in thinking, okay, Myanmar's opening up, I'm going to go and buy a bunch of real estate because the place is going to boom. Well, that's just not the case, at least not in my humble opinion. So I guess the answer to all of this is that assuming things work in the same manner in all countries is foolhardy. What an intelligent person needs to do is to go and spend some time on the ground, a lot of time, try and understand the cultural norms that understand that business practices differ, understand the nuances in communication, and not dive in until you have a solid reason to do so, and until you've mitigated the risks around investing in these places. And then, yes, you can make enormous amounts of money. Um, but it is not something that you can or should just hit a button on your computer trading screen in order to purchase. Certainly not in countries that are at that growth stage where, well, I mean, Myanmar doesn't have listed equities. They don't have a stock exchange, for example. Um, I think that's perfectly possible in emerging markets. Again, you need to do your research and make sure that you understand what you're investing in. But coming back to your question, I think Myanmar is one place where there's a lot of hot money, which is not to say there's not good companies and there's not people who make enormous amounts of money. It's simply that a lot of the capital going in now, I don't believe, is going to find a healthy home. I think that there's a lot of people who will lose money.
What are perhaps some of the other markets that are more out of favor in your universe, where you look for opportunities that you find some good mispricings?
Sure, sure. We believe Cambodia is a relatively good place to place capital right now. There's not a lot of hype about it. It's a very small economy. It has, again, it's got all of the fundamentals, which even places like Myanmar has, but it doesn't have the hype with it. It doesn't have people running in there with bags of cash, eager to jump in. Um, and so there's some interesting developments in Cambodia. Other places that are of interest to us are places like Mozambique, which is opening up. Um, and so I grew up in Africa, so that's sort of a little bit closer to home for me. Mozambique's interesting. They've got massive natural gas reserves, um, and there's not an enormous amount of happy-go-lucky investors running into to participate in the place now. Um, a friend of mine went recently and had a look, and we were looking at, for example, commercial warehouse space, which if you bought it and you leased it out at current market rates, you would pay back your capital in about 18 months, and then everything else is free cash flow. So that sort of gives you an indication of some of the opportunities that exist. So Mozambique is interesting to us. And yeah, Cambodia, we're looking at deals in all sorts of countries. Like I said before, we always spend a lot of time on management, and so we will follow a particular person into a deal. We're looking at a deal in Thailand at the moment, which is actually run by a German couple. And Thailand itself, I don't believe is particularly undervalued, but in this little niche market that they're in, they're doing ridiculously well, growing revenues very quickly. They've got a unique product and very competent management. So, we'll look at deals like that. Cambodia is interesting in that they opened up a stock exchange last year. They had one company got listed, Phnom Penh Water, which came out of the gate like a bull on steroids. And since then, they haven't had any other listings. This is partly due to companies needing to have had audited results and things like that for a sufficient time frame before they can get listed. So we believe it's going to be an interesting place over the next 2-3 years. There are 14 companies right now which are seeking a listing that will likely get listed this year. Maybe not all 14 of them, but certainly a decent slice of that. And again, you've got most of these companies are very small. If you look at a company like Apple, for Apple to double is very, very difficult. It's almost impossible. But if you take a small company that's worth, $10 million, for it to double is not hard at all. So that micro space is of interest to us, combined with illiquidity. If we can get in at valuations that are highly attractive, we will. So, and when I say we're looking at valuations that are highly attractive, that is essentially our risk mitigation process. We don't merely buy companies that are, we think, undervalued. We basically want to steal them.
Uh, that certainly is helpful, how you describe it. I'm curious to also go back to your approach in private as well as public markets. So in the case of Cambodia, then how do you play those IPOs? Certainly in the US market, as contrarian investors or value investors, we tend to shy away from IPOs. It's not a great situation where you've got people basically selling something to you for you to be a buyer. But can you give us a flavor for why IPOs may be a good opportunity in frontier markets like Cambodia, and at what stage do you like to get in?
You make a great point there, Oliver. What I think what investors always need to be cognizant of is the fact that an IPO is a setup where the insiders are selling. Now, for the most part, when insiders are selling, you need to ask yourself the question of should you be buying what the insiders are selling when the insiders know more about the company than you ever will? Now, there are perfectly valid reasons for companies to raise capital. Um, and at the same time, but, what should I say, but there's almost only ever one reason that insiders will buy stock, and that's because they think it's going up. Um, Now, IPOs, we don't, we almost never like buying companies on listing. Again, you've got insiders are selling the stock to you. You've got brokers who are going to tell you that it's the best deal under the sun. Investment bankers will do the same thing because they're making money on it. And you need to be very sure of what you're buying and why. So we don't typically participate in IPOs. We much prefer to participate in a company prior to its listing in private placements, and then exiting on the IPO. Um, but the point that I made with Cambodia is more along the lines that with more companies listed, it typically brings a higher level of interest into the country, and that brings capital flows. So on the private equity side, if you've got a conduit for private equity to exit, then you typically find that there's greater levels of private equity coming in. So if for example we have 14 of these companies listed in Cambodia, you will now have 14 companies listed on the exchange. There will be far greater, well, there'll be 14 times the amount of liquidity that currently exists, even if that liquidity is very low. It also sets precedents for existing companies that are not yet public. And private equity firms like that. So they will start looking at businesses which they believe can be taken public. And that starts bringing capital into the private equity space, and it brings valuations up, and ultimately uh, can contribute to raising the general equity markets. So from a sort of macro sort of view, Cambodia is interesting from that perspective. I'm not saying that we're going to be participating in any of these IPO listings. In fact, we probably won't. Um, but the simple fact that there's a lot of them will be coming public is liable to generate interest in the country. And when it generates interest in the country, it will bring additional capital in. And that's going to be both in the public as well as the private markets.
I just want to go back to what you mentioned about looking for the right management teams and using in a way a jockey type approach to investing in frontier markets. Is that very much a way then how you generate investment ideas? You simply know the people that you respect and know that they've created value in the past, and you back them, provided this, all the other factors are attractive. Um, is that very much a source of idea generation? And can you tell us any others that you like to employ in looking for opportunities in frontier markets?
Right. So I guess we look at the world from a macroeconomic viewpoint, and we try as best as we can to identify countries which have strong tailwinds behind them. Those tailwinds can be anything from enormous resources to demographics to political changes such as Myanmar, or a combination of all of them. Um, and so that's how we would start looking at a particular sector or a particular country. Then, when it comes to making actual investments, we have our favorites with respect to sectors that we will or won't get involved in. So, uh, for example, film. I mean, if some particular business came to me and said, "Look, I'm trying to raise money to create a Bollywood film, and I really think India is a great idea," I'll just say no because I don't know the first thing about film. And the little that I do know is that people I've spoken to about it have always lost money. So I would never get involved in that. But um, we try and identify the sectors that we're a lot more comfortable with, consumer goods, things, companies where we can see and evaluate the business plan and it makes sense to us. And then we focus and find the best possible team and management that we can. So from that aspect, it tends to be more of a bottom-up approach, and we'll look for companies that have strong management, massive incentives on their own side, so where they put all of their own capital or a big chunk of their own capital into companies, um, and preferably where they have proven themselves in the past. So that those are the sort of the parameters, and then of course it comes down to the actual deal and valuations and structuring it in such a fashion that we can have an exit. So if it's a company which could be taken public, that might be a strategy, or it could be simple trade sale. So we've made quite a few investments in companies which, with the strategy is that it will be trade sold, a lot in the technology space. And the other is dividending your investment back out. So the company that I mentioned very briefly before, in Thailand, we would, under the terms of the deal that we're negotiating now, we would be able to dividend our entire capital back out in just under 2 years, and then everything else would be free cash flow from that point onwards. So those are essentially the parameters around the particular deals that we would look at. Um, but management is easily the biggest, most critical point for us to consider.
Do you ever run any screens on the public markets as a kind of first step in doing some, looking for opportunities?
Well, we keep an eye on valuations in the public markets because it's just the overall perception. And if you're going to be looking for, we like bargain hunting. So while we're not, if we're looking for opportunities, we don't necessarily have to be participating in private deals. We're more than happy to invest in deals that are public. Um, the only criteria is that we really want to be stealing them. We find it's a lot easier to do so in the private markets, but that doesn't mean that we can't do it in the public, as I've just mentioned with Mongolia. So we'll keep our eye on particular markets we're interested in, and if they are as an overall undervalued, then we'll start looking a lot more intently at those markets, and we'll buy into public companies where we see opportunities in that space. So to answer your question with respect to screening, we spend a lot of time really just keeping our finger on the pulse of particular markets, and if we see some opportunities, then we start we'll look at them.
Now you've been investing in these markets for a very long time, and you more than most other people, you are actively on the ground, visiting companies, knowing the people there. What would you say are the biggest mistakes that investors make in these so-called frontier markets?
Assuming things work in the same manner as in countries which the investor might be used to, it's just not an intelligent thing to assume anything. Cultural norms differ, business practices differ, nuances in communication all bring a certain level of understanding, and that's essential. Sometimes no means yes, and a nod and a smile doesn't actually mean that any agreement has been reached, and so forth. Anybody who's participated in these markets will know what I'm talking about. So I think that the mistakes are typically made from an ignorance and being far removed from your investments. You know, the further you are removed from your investments, the greater the level of risk. If you're sitting in New York trying to figure out how to buy equities in Cambodia, you're at a significant disadvantage. And the same is true anywhere else in the world. So um, that's that's possibly one of the biggest mistakes I think that you could make. Um, and the other mistake I think is in size. So I think if you look, I'll give you a little example to probably better explain and it's a mistake that I've seen being made. There was a lot of capital about 10 years ago was raised for funds who were investing in Mongolia. A lot of this capital um, was raised in the tens of millions of dollars. Now, if you spent even a week on the ground in Ulaanbaatar, you would very, very quickly realize that you cannot allocate that amount of capital, not in any intelligent, prudent fashion. If you have $1 million in Mongolia, you could make a lot of money. If you have $20 million, you have a problem. And that is because the sheer size of the businesses there are minuscule. And that's really where we see a lot of opportunity. So there's companies that are looking that are maybe $2-3 million market caps, and they're looking to raise $500,000 to expand their business, and they're growing at 50-60% a year. That's of interest to us. But if you're a portfolio manager with $100 million under management, you can't be allocating $500,000 to investment. Even if you did 10 of them, you're going to get to the end of your financial year and your investors are going to say, okay, Joey, what did you do? And you're going to turn around and say, well, we did 10 deals here and we managed to allocate, half of, $5 million. And they'll say, what? Are you nuts? And they'll start selling. So um, there's, that's, there's a lot of capital that we've seen raised and in these markets and it hasn't been allocated. There's one fund in particular who raised $80 million, and they haven't done a single investment, and they're going to be liquidated in about a month's time. So investors have paid dearly for that because they've been paying 2 and 20, so they haven't paid the 20, but they've been paying 2% for 2 years for these guys to sit on their bum and do nothing. I mean, I guess it's a nice gig if you're a portfolio manager and you manage to raise $80 million, sit on it for 2 years and collect, what would that be, about $3 million in fees to sit and drink coffee. But that's not a particularly good deal for investors. So a lot of investors will look at things and say, okay, fine, I don't want to go to Mongolia. I don't want to go and research these companies. I've got a job and I've got kids to look after and so on and so forth. So they want to invest in a fund, but they don't understand that that fund that's gone and raised 50 or $100 million is not going to be able to allocate that capital intelligently unless they get into large mining projects. It's just not possible. So there's funds that will be set up and then I've seen the same thing in Myanmar. Funds that are set up to take advantage of, say, consumer goods. and they're raising $200 million. I mean, it's it's completely nuts because the sector doesn't even exist anymore. It's not even like you can go out and buy companies that are in that space. You could buy every single company in the country that is in the consumer goods space, and you still would not reach $200 million. So, um, yeah, that's a big risk, and investors need to sort of understand the scope of the country that they're investing in, and then see if that makes any rational sense with the fund that is telling them they should be giving their money to them.
Yeah, that's a great point, and I guess in a way it's good news because for private investors who perhaps don't have as much capital, there's an opportunity with an intelligent approach that you've described here to take advantage of these institutional fund flows and the euphoria and just be contrarian and smart. And it seems like a paradise for private investors who know what they're doing.
Well, it's one of those things, Oliver, where you've got these funds who are desperately looking to allocate their capital. Sometimes they have mandates whereby they need to allocate X amount of their capital within a particular time frame. So, we will look at small companies which we will fund, we'll seed them, fund them, um, grow them to a point where they can then go and be sold to funds because these funds are desperate to get these investments. And that it's not unusual for that to happen at 5, 10x of our initial investment. The funds are happy because now they've bought a boutique hotel chain, for example, in Myanmar, and they think it's a pretty good deal because they've only paid, I don't know, $5 million for it, um, and it's cost us maybe $700,000 to build the thing up. So there's a lot of opportunities. We see a lot of opportunities in that space, and yeah, I mean it's a difficult. The reason frontier markets are frontier markets is because they're difficult to operate in. It's not anything that you can just buy on a ticker symbol with your E-Trade account, and it's not even something that you can go and waltz in and spend a week on the ground and decide what you're going to buy and waltz out and make your investment and go back to your job. It's fortunately or unfortunately it's not that simple. Um,
Now,
Yes,
to
for us it works because the returns are we haven't been able to find the kind of returns that are achievable in other markets, not without taking on enormous leverage. And yeah.
Now, on your website, CapitalistExploits.com, you share some of your observations and interesting opportunities that you come across, as well as you share some of the research about countries and specific markets there. I'm curious if you could share perhaps with our audience some of your favorite resources in addition to your own that are perhaps available for free online, or even some books that you think would help somebody in New York or London get a bit more of a flavor for what it's like to invest in these markets.
Yeah, there's no easy answer to that, Oliver. I mean, it's the reason that we set up the blog, I guess. The level of information and quality resources available is poor in many of these markets, um, and you know there are research reports out from particular fund groups which are decent, but when we consider that we've only got a very, very small participation level from fund managers in frontier markets. It's no surprise that there's, at the same time, very few quality resources available. I mean, I think it would be if if we start seeing frontier markets are the best place to be all over Time magazine and having Goldman Sachs and JP Morgan beginning extensive private equity research in frontier markets, then it's probably a time that we should start exiting those markets. Um, but to answer your question, there's there's a report that we're going to have on the website very shortly on frontier markets, a sort of overview, which will just be free. Anyone can go and download the thing. Other than that, there are a few resources. There's a friend of ours in Mongolia who provides um, uh, equity research and overall market research. Um, and let me just see if I can find what it's called Cover Mongolia. If you Google it, you'll be able to find it. Um, and then there's another company which I've found. I haven't reached out to them yet. Oh, I've had a brief conversation with them. A company called Everest Capital, who cover a lot of frontier markets. They've produced a number of white paper reports on frontier markets, and I've found all of them very well researched, very well done. Um, you can Any readers can go onto their website, just Google Everest Capital. Again, I have no affiliation with them. I've just found their resources. I've spoken to the CEO and a couple of times. Seems like a nice chap. Their research looks good. Who else? Um, Books. Uh, I guess readers can familiarize themselves with any of Jim Rogers' stuff, which is really just an overview of the particular some of the countries that are of interest. Um, Research reports themselves are difficult to come by, Oliver. To be honest, I mean, there's a bunch of them out there. I consistently read them and often find problems with them. They're just incorrect or not extensive enough to be of great value to me. Um, and I think that the easiest, if someone is really interested in these markets, what they need to do is speak to businessmen and not to investment bankers. You go and you find a business council, for example. In fact, that's a good point. There's a business council of Mongolia. Anyone can go on the website and you can purchase. They do monthly reports. Business Council of Mongolia. It's run by a gentleman by the name of Jim Dwyer. Again, I don't have any affiliation with him. I've met him. He's a wonderful gentleman, and you can buy their reports. They're very cheap. I don't know, a few hundred dollars a year, and that gives insights from business in Mongolia rather than investment bankers and things like that. Um, Really worthwhile doing. So any market, that's what we do for due diligence. Trying to investigate particular markets, say Mozambique. We're interested in agricultural space in Mozambique, and so I contact farmers and I speak to farmers, and I've built up a network of farmers in Mozambique who provide me with information, and I think that's the way to go about doing things. You tend to get a less tainted view of the current situation. Um, and at the same time, you've got to realize there is a bias. Even farmers have a particular bias. I have a particular bias. And it's always a challenge to make sure that you're trying to assess something correctly and not letting um, underlying biases uh, misguide you.
Well, that is a great point, and I really want to thank you, Chris, for being so generous with your time and sharing all the uh, well, part of your vast experience here on this call with our audience. I've certainly learned quite a bit, and I've come away perhaps appreciating a bit more what it takes to invest in these markets. And you've also given us a couple of great ideas with Prophecy Call, especially. Thanks so much for sharing those ideas with us, and look forward to speaking to you again sometime in the future. Again, anybody who is interested to find out more about Chris's exploits, please visit his wonderful website at CapitalistExploits.com. Chris, thank you very much.
It's been a pleasure, Oliver, anytime.